We are watching Enliv Therapeutics Limited, ticker symbol ENLV, trading live right now at exactly $1.10, registering a massive intraday surge of 23.24%. If you are watching the charts this morning, you are seeing a vertical green candle that defies the typical sluggish movement we expect from small-cap biotechnology firms in a consolidation phase. This is not just a standard volatility flush or a technical bounce off a double bottom. This is a repricing event occurring in real time, driven by a convergence of fundamental clinical data and a radical, almost unheard of shift in corporate treasury strategy that separates this company from 99% of the market. The volume flowing into this stock today is eclipsing its average daily turnover, indicating that this is not just retail speculation, but likely involves institutional repositioning and algorithmic aggressive buying. When you see a stock trading at just over $1 making a 20+% move, the immediate assumption, the expectation, is that this is a pump and dump or a fleeting reaction to a minor press release that will fade by the closing bell. Most investors, perhaps even those using a standard Robinhood app or checking their Schwab Intelligent portfolios, will glance at this, see a penny stock spiking, and dismiss it as noise. That is the expectation. The reality, however, is far more complex and potentially far more lucrative for those who understand what is actually happening under the hood of Enliv today. The reality is that we are looking at a company that has effectively bifurcated its identity, delivering positive, durable clinical data in a massive, addressable market, osteoarthritis, while simultaneously embarking on a financial engineering strategy that mimics the most aggressive moves in the tech and crypto sectors. You are not just looking at a biotech chart, you are looking at a hybrid vehicle that is challenging how we define value in the life sciences sector. To understand why this move to $1.10 is significant, we have to strip away the surface-level noise and look at the market mechanics. A 23% move in a single session for a stock like ENLV creates a liquidity vacuum. Short sellers who may have been sitting comfortably on positions betting against the company's cash runway are currently being squeezed. The cost to borrow shares often skyrockets in these scenarios, and as the price pushes past the psychological barrier of $1, we trigger a cascade of buy orders from technical traders who view this as a breakout confirmation. If you are sitting at home managing your self-investing strategy or looking at your Fidelity brokerage account, you need to understand that this price action is a battleground. The expectation was that Enliv would struggle with liquidity and funding as it moved through expensive clinical trials. The reality we are seeing today challenges that bearish thesis entirely. This creates a curiosity loop. How does a small biotech company suddenly command this kind of volume and attention? The answer lies in a dual catalyst event that is rare in the market. Usually, you get a drug approval or a financing round. Today, we are seeing the market digest a complex narrative involving macrophage reprogramming technology and a blockchain-based treasury reserve strategy involving RAIN tokens. This is the definition of reality exceeding expectations because nobody had crypto biotech hybrid on their bingo card for Enliv this quarter. Let's dig into the first half of this equation, which is the foundational value proposition that many long-term holders, perhaps those of you who focus on Fidelity mutual funds or Fidelity ETFs that track healthcare, have been waiting for. The company has released positive 6-month top-line data from its Phase 2A trial of Allocetra in patients with knee osteoarthritis. This is not a small niche. Osteoarthritis is a debilitating condition that affects hundreds of millions of people globally, and the current standard of care usually involves corticosteroids, which have diminishing returns, or painkillers that mask the symptom without treating the cause. Expectation was that Allocetra might show some safety data, but likely struggle to show statistical significance in pain reduction this early. Reality? The data shows durable, persistent pain reduction and improved function. This is critical. In the biotech world, durable is the magic word. It means the drug doesn't just work for a week, it works for months. This changes the revenue model potential from a chronic maintenance drug to a potentially disease-modifying therapy. When you see a stock up 23%, a large chunk of that is the market pricing in the possibility that NLEV has cracked the code on a condition that Big Pharma has failed to solve for decades. However, the story gets infinitely more complex, and this is where we have to talk about the financial structure. Reports are circulating regarding a massive private placement, upwards of $212 million, but with a twist that you would expect from a tech startup, not a drug developer. The capital is reportedly tied to a strategy involving RAIN tokens, a blockchain asset linked to prediction markets. This is where the Interactive Brokers trading crowd and the Robinhood crypto enthusiasts might suddenly find themselves in the same room as the medical science investors. The company appears to be positioning itself as a pioneer in using digital assets as a treasury reserve, somewhat similar to the strategy that turned MicroStrategy into a Bitcoin proxy, but focused on the prediction market sector. This is a high-risk, high-reward pivot. The expectation for a biotech company is to raise cash, burn it on R&D, and hopefully get acquired. The reality here is that NLEV is attempting to create a self-sustaining balance sheet through alternative assets. This explains the volatility. It explains the volume. It explains why the stock is behaving like a tech high-flyer rather than a sedate medical researcher. It creates a tension in the stock price. Are you buying the cure for arthritis, or are you buying a hedge fund disguised as a lab? This brings us to the science of Allocetra itself, because without the science, the financial engineering is meaningless. Allocetra is based on macrophage reprogramming. Macrophages are the big eaters of the immune system. They engulf cellular debris and bacteria. In conditions like sepsis or severe osteoarthritis, these cells get confused. They start attacking healthy tissue or fail to shut down the immune response, leading to cytokine storm or chronic inflammation. Most drugs try to block a single pathway, like putting a finger in one hole of a leaking dam. Allocetra effectively resets these macrophages, telling them to stop attacking and start healing. It's a homeostatic restoration therapy. If you are into online investing and looking for deep value, you look for platform technology, treatments that can be applied to multiple diseases. NLEV has tested this in sepsis, a condition that kills millions and has no approved drug treatment, and now osteoarthritis. The success in the osteoarthritis trial validates the platform. It proves that resetting macrophages works in humans, not just in mice. This reduces the clinical risk for the sepsis program and potentially opens doors for treating other autoimmune disorders. The market is just beginning to wake up to the fact that this is not a one-trick pony.